7 Simple Steps to Becoming a Millionaire. By StockCryptoBonus.com. It's easy to think that millionaires are a small group, but you might be surprised to find out that there are a lot of them walking around. According to the Credit Suisse Global Wealth Report, about 9% of all adults in the United States are millionaires, and you could be one of them one day. It's important to note that while having a net worth of $1 million or more sounds like a lot, depending on the cost of living and standard of living, it may not be a sustainable level of wealth for an individual or family. It can also vary greatly depending on location, as the cost of living in cities like San Francisco or New York City is much higher than in rural areas. It's also important to remember that being a millionaire does not always translate to financial security or stability, as expenses and lifestyle choices play a large role in overall financial well-being. But if you want to become a millionaire, or more precisely, someone with financial security and a sustainable level of wealth, here are 7 simple steps to get there. 1. Think about long-term goals. Instead of saving or investing without a plan, millionaires have both short-term and long-term goals. It can be hard to think about long-term goals, but it's an important step toward reaching them. Start by thinking about and writing down what you want to accomplish in the long run. Think about what success means to you and be as specific as you can. Then, break your goals into smaller steps that you can handle and set a deadline for reaching your goals. Having a deadline in mind will help you stay focused and motivated. Make sure your deadline is reasonable and doable, but also hard enough to push you forward. Make a plan of action. Based on the steps you've found, make a plan of action that lists the tasks you'll need to do, when you'll do them, and in what order you'll do them. Start putting your plan into action right away. It's easy to get stuck in planning and thinking about your goals, but taking action is the only way to reach them. Remember to be adaptable. Be ready for changes and things you didn't expect to happen along the way. To reach long-term goals, you need to be able to change your plans. Finally, check on your progress. Keep track of your progress on a regular basis and make changes to your plan as needed. Small victories along the way will give you the boost you need to keep going. Remember that setting long-term goals takes time and work, but with a clear plan, consistent action, and a positive attitude, you'll be well on your way to achieving them. 2. Put money in when everyone else is panicking. No one wants to put money into something that will lose value over time. So, when the stock market starts to go down, many investors rush to get out in order to avoid more short-term losses. The thing is, when stocks fall, it may be the best time to buy them for the long term. If you see that the price of good stocks is going down, you might want to buy them up. The strategy of investing during market panics is known as buying low. The idea is that by purchasing assets when prices are low, you can potentially realize larger returns when the market recovers. This strategy is often associated with the famous investor Warren Buffett, who has said that be greedy when others are fearful. Before investing during a market panic, it's important to do your research and be sure that you understand the risks involved. It's also important to be aware of your own risk tolerance and investment goals. If you are not comfortable with the potential for substantial losses, it may not be appropriate for you to invest during a market panic. However, to become a millionaire, some level of risk may be necessary. 3. Taking some risks may be necessary. Some investors might want to make as much money as quickly as possible, so they might put more money into stocks and other securities that have the potential for a high return. Generally speaking, the higher the risk, the higher the possible return. But not everyone is cut out for high-risk investing, especially since high-risk investing can also mean a high loss. One way to try to reduce the risk and be able to take advantage of the opportunity is to invest gradually, so you can buy at different levels as the market goes down. This way you will average your cost and will not put all your money at one point. You can become a millionaire by going slow and steady. You can find index funds and exchange-traded funds, ETFs, with less risk and keep adding to your investments. Put it in your monthly budget, so you'll treat it like a bill and not just an afterthought. Not only does it have a lower risk, but it also has a higher chance of working. The S&P 500 index, which is a group of hundreds of the best companies in the US, has given about 10% annual gains over time. It's a good place for new stock investors to start. 4. Don't get into a lot of debt. Most people have to deal with debt every day. But having debt can stop you from investing. The more you have to pay off debt, the less money you have to invest. Try to pay off as much of your debt as possible. You can start paying off your debt in different ways, such as the debt snowball or debt avalanche. After you've paid off your debt, you can invest any money you have left over after paying your regular bills. Of course, it's important to tell the difference between debt used for an investment, like a house, and debt used just to spend. Many wealthy people, if they can afford it, use debt to buy assets that go up in value, like houses. 5. Diversify your portfolio. If you've put all your money into the best stock because you think it will make you rich, think again. You're putting a lot of your financial weight on one asset, which puts you at a lot of risk. Millionaires also think defensively, and they often get rich by diversifying their portfolios with a mix of stocks, bonds, mutual funds, ETFs, and other securities. They reduce the chance that any one investment, especially a big one, will hurt them too much. Don't put all your money into one type of investment. Instead, spread out your money. Even if one security fails, your other investments will help you get by. You might also want to look at other investments, such as real estate, to add variety to your portfolio. 6. You don't need to look like one. If you have an idea of what a millionaire looks like, you might want to rethink it. Millionaires don't need to have flashy cars or huge homes. Millionaires can look just like you right now. You don't have to shop at expensive stores or buy name brand items to fit in with the crowd. Instead, put more time and effort into building your wealth through investments, not by buying stuff. Millionaires aren't rich because they spend money, but because they didn't spend it. 7. Find the help you need when you need it. You don't have to go into investing alone. If you're starting from scratch, you might feel a little overwhelmed about what to do next. Millionaires call in the experts when they need help. Talking to a financial planner or advisor might be a good option, but it's not always the cheapest. If you don't want to pay for personalized financial advice just yet, this is one way to get started. Join a robo-advisor, which will invest for you based on your goals and needs. You can set up the account to automatically add money, such as every month. The algorithm then invests and manages your portfolio for you. Also, the fees are low. If you feel like you're stuck and could use more help, talking to a financial expert might get you to the next level. Remember that not all financial experts are the same, so find out which ones have your best interests in mind and know what they're talking about when they give you financial advice. The bottom line. Though it may seem daunting at first, with the right mindset and strategy, the path to financial success becomes clear. Ditch the burden of debt and embrace the power of long-term investments in a diverse array of options. Forget the noise of the crowd, and pave your own way towards your unique aspirations. And remember, there is no shame in seeking guidance along the way. Disclaimer: all investors are advised to conduct their own independent research into investment strategies before making an investment decision. This video originally appeared as an article found at StockCryptoBonus.com. Read more articles like it and get more information, tips, and advice about the stock and cryptocurrency markets at StockCryptoBonus.com. Don't forget to subscribe and click on the bell icon to get notification to get our latest videos on big investing and financial topics of the day.